Welcome to the High Yield Real Estate Investing Podcast, a podcast focusing on multifamily investing in short, easy-to-digest 5-minute segments.
Hi, I'm Brooke.
And I'm Dan. Even if you've gone through the mortgage process for your own home, there are a few vocabulary terms you should familiarize yourself with before you pick up the phone and start shopping lenders for that investment property you want to purchase. We'll clarify terminology for commercial loans here in episode 2 of our loan series.
Leverage, note, paper, loan, debt, financing. These are all terms describing money that you borrow from a lender that you use to buy a property.
Loan to value. Size of the loan versus the value of the property. Residential loans for owner-occupied housing can be up to 100% LTV for VA loans and 95% for FHA loans. If you're an investor, then plan on paying a maximum of 75% LTV for that property. Your lender may require something lower than 75% depending on their own lending standards.
Mortgage. The document that says you are putting the title to your property up as collateral until you pay the lender back. Not to be confused with
Promissory note. This is the document that spells out how you repay the loan, including details such as term, interest rate, amortization, principal amount, monthly payment, etc. When anyone says they had to do something because they had to keep paying their mortgage, they actually mean their promissory note.
APR, annual percentage rate. The rate describes how much interest you're paying on the principal each year.
Annual percentage yield. The percentage of the loan principal you'll have to pay over the year. This includes the frequency and details of compounding loan interest. The annual percentage yield is always higher than the APR.
Amortization schedule. This describes how the loan would be paid off with scheduled payments. Principal and interest portions of the payment are different for each payment. The typical loan starts off as mostly interest payments and slowly converts to being mostly principal payments at the end of the amortization period. A 30-year residential loan means that your loan will be completely paid off at the end of the 30 years. You could have a loan with a shorter term, like 5 or 10 years, but it would amortize over 15, 20, or 30 years.
Term. How long until your loan is due? Not all loans are completely paid off at the end of their term. This is especially true with commercial loans.
Balloon payment. If your amortization period is longer than your loan term, you'll have to pay the remaining balance of the loan off at the end of the term. Most investors refinance into another loan or sell the property before the balloon payment is due.
Adjustable rate mortgage. After a specified period, the loan rate will adjust based on the market rates and whatever else the lender defines to set the new APR. Usually, the initial interest rates on these loans are lower than fixed-rate loans. The lender is hoping that you'll have to refinance into a higher-rate loan after the initial term is up. Adjustable-rate mortgages are usually denoted as 5-1, 5-5, 10-1, etc. The first number is the initial period of the loan at the advertised interest rate. After the initial period, the rate adjusts at the period of the second number. 5-1 is the most common.
Fixed-rate mortgage. Just like it sounds, the interest rate is fixed for the term of the loan. The most common product in the residential world is a 30-year fixed mortgage. The amortization period and the loan term are the same. However, you can have shorter-term fixed-rate loans as well.
Hard money lenders. These lenders provide short-term interest-only loans at a high interest rate, usually for only a year or less. If you want to flip houses, need a fast close, or can't qualify for conventional lending, these are the lenders you seek out.
Prepayment penalties. If you have a mortgage on your personal home, you probably don't have any of these. You can pay off your home mortgage anytime without penalty. However, if you have a commercial loan, the bank wants to make sure it's going to get its return on investment if you pay off the loan early. They can do that in a few ways. Usually, it's a fee that is based on the percentage of loan that's still outstanding when you pay it off early. After all, if you're in the business of lending money and collecting interest as your profit, you want to make sure that you're guaranteed that profit.
Recourse or non-recourse? Can the bank come after your other assets if you get foreclosed on and the bank didn't get all of its money back? Most non-residential loans under $1 million are this way. Once you get over the $1 million amount, you'll get into the non-recourse territory. Here, a lender can't come after your assets if you default, unless you misrepresent yourself or commit fraud, of course. Also, if you're using a retirement account to buy properties and need lending, you'll have to find a non-recourse lender.
Underwriting. The process the lender does to assess the amount of risk that you as a borrower represent to the bank. The more risk, the higher the interest rate and crummier terms you'll get. If the perceived risk is too high, then a lender may refuse to even lend to you.
Debt service coverage ratio. We've covered this one in previous episodes, but you'll find this used in commercial loans. The bank wants to know that if you got some padding in your rents over what the cost of the loan is. That way, an unexpected repair, vacancies, or even a pandemic won't affect the bank collecting their money. Example, if the loan costs $10,000 a month and you collect $12,500, then your DSCR would be 1.25. Expect banks to look for 1.2 to 1.25 minimum.
Residential loan. These are loans on owner-occupied housing or housing with 4 units or less. If you want to own your duplex or another property in an LLC, though, you'll have to get a commercial loan.
Commercial loan. Anything above 4 units of multifamily or other types of commercial property like retail, office, and industrial properties.
Stabilized property. The property has held at or above a certain occupancy level, usually 80 to 90% depending on the lender, for a certain amount of time. 6 months is most common. If the property is below this threshold, it is considered unstabilized, and the lending terms will reflect that.
Assumable loans. The lender states that another party, usually the buyer of that property, can take over the loan that's already in place subject to the lender underwriting the new buyer. Expect to pay a fee for this privilege.
Agency debt. Fannie Mae or Freddie Mac loans.
Liquidity requirements. The lender wants to see you can either pay the loan for X amount of time after you close or have a certain percentage of liquid assets remaining after closing. If there's trouble with the property, the bank wants to know you have enough liquid assets to pay the loan.
Guarantors. The people who put up their personal assets to repay the loan should the property be unable to do so for any reason.
Sponsors. The person or entity that's buying the property and taking out the loan.
Is your head spinning with all this new vocabulary? Listen to this again if you need to. We'll also post the script online for your reference.
Thanks for listening. If you want to learn more, go to highyieldre.com. You can also email us at info@highyieldre.com.